The Blockstream app is your gateway to financial freedom on Bitcoin. Built by the team behind more than a decade of Bitcoin innovation, it's the easiest way to buy, secure, and manage your Bitcoin. Download the Blockstream app and start stacking straight to self-custody today. The future of finance runs on Bitcoin.
Today on Bitcoin Capital, we're joined by James Seyffart, research analyst at Bloomberg Intelligence, and along with previous Bloomberg guest Eric Balchunas, one of the leading experts on Bitcoin ETFs. James has been tracking the evolution of ETF products since the early futures filings and has played a key role in interpreting how the launch of spot Bitcoin ETFs have reshaped investor access to Bitcoin. In today's episode, we break down the structural forces behind the wave of ETFs, dig into some of the history, discuss structural bottlenecks like custodial concentration, and talk about how Bitcoin is being integrated into institutional portfolios and corporate treasuries. James, welcome to the show.
Hi, Jesse. Thanks for having me.
Great. So we've had Eric on the show previously. He did an interview with us in El Salvador, and I also bumped into him in London actually a couple of weeks ago. So I wanted to ask, how do you guys work together? How do you split up the coverage?
That's a good question. Really, so for a while, I was the one that told him everything about crypto. He was it was just this tangential thing that he was interested in. He was never anti, like a lot of other people you meet in TradFi world. But so for initially, it was anything crypto. He was checking in with me, is this right? Is this how you think about it? And that's how it worked. And then, he, as one does, you tend to go down a bit of a rabbit hole. And, he's learned his own things. We have differing views on different things now, whereas at one point it was whatever my views was, he was that's what he's going to say publicly because he didn't understand it well enough. But obviously over the years, he's got to come his own strong opinions. For the most part, we don't really have set who covers what. It's I'm around to do this. This is breaking. Can you look into it? Or I have something going on, or vice versa. So really, we don't really split up what we do on the crypto side of things. We don't really split up anything we do. Our team, we have a whole team of people, and we don't really split up anything. If something big is happening and you just kind of say, hey, do you mind if I write about this? If it's kind of somebody's area, but for the most part, anyone can write about anything on our team. So for this stuff, I'm a little more in the weeds. I'm the one looking at the filings. I'm the one tracking in Excel spreadsheets and the dates and all that stuff. He still checks with me on that. But as far as anything else goes, we kind of basically will cover the same stuff. And a lot of our coverage is us debating on the back end, what is the right thing? When we come up with odds, we'll argue what we think is likely and not likely. And he'll think it should be higher. I think it should be lower. And we kind of settle in an area. So a lot of things is an amalgamation of our two brains, essentially.
Oh, that's very cool. So the ETFs have been a really long time in the making. I think, correct me if I'm wrong, but I think the first one was from Gemini way back in 2013. Is that right?
Yeah, the Winklevoss filed when I think Bitcoin was $100 a coin. So it's been a long time coming.
Yeah, and then we had a decade of applications and rejections. Where in that period did you kind of get interested in this? What attracted you to it? And when did you feel like the ETFs were starting to get some traction?
So that's a good question. The first thing I will say is everyone likes to point to that as though the SEC was wrong. I think they were right to deny those things for years, for the way they were structured, which we can get into if you want. But only until 2019-ish was I okay, I think these things can actually handle an ETF now, this marketplace. And then, so when did I get interested? Really, I technically, my laptop was mining Bitcoin in 2011 because one of my floor mates in college was interested in using it for Silk Road reasons. And he was let me just put this on you can get free money on the internet. We'll just run your computer. And it blew up my computer. So my interest was, I hate this thing. I lost a 12-page paper. But really, it was Kathy Wood. I was at a TradFi ETF conference, a Morningstar ETF conference that doesn't exist anymore. It merged into their other conference in fall of 2016. And ARK Invest had written their own white paper on why Bitcoin was the future of money and decentralized money and all these different things. And that's when I started really taking it seriously. And then, so from then on, I was interested personally. And then also later that year and into 2017, I was covering the grayscale products and all the trusts. And there was a lot of inefficiencies and premiums and discounts. And that's an area of my expertise. I do a lot with closed-end funds as well when I write my research because it's just a unique area, but it's very niche. So that was my first foray into like doing it professionally. And I also worked with, so when I went to Bloomberg Intelligence, which is Bloomberg's research arm, I worked with Eric, the ETF side, asset management funds, what you know us as today. And I also worked with Mike McGlone, who's our commodity strategist, who covers crypto as well. And so when I joined, he was like, he came to me and he was like, "Hey, what do you know about crypto?" I was like, "I know a lot about crypto. I've been trading it. A lot of it's garbage, blah, blah, blah." And he's like, "All right, I want to start covering it professionally." So we started running it from the base level, and like we did like cryptocurrency 101 about like what is a block, what is a blockchain, like that type of research on Bloomberg. Because back then people were like, the whole saying was, blockchain, not Bitcoin. Some of that's kind of coming true now, but like, so that we were just answering a ton of client questions of like real basic stuff. Like, what is this? Why does it matter? Should I care?
That was like a classic JPM 2014 was blockchain, not Bitcoin, right? So there must be shirts out there like that. Um, the Grayscale products were really interesting because I think when they released that, I think they actually tried to run it as an open-ended fund, and I think they got their wrists slapped, and then they tried to apply for redemption and weren't able to do that. That was kind of an interesting situation that was kind of created by the regulators, I think, and then had those like massive premiums. I mean, that had a real ripple effect through the whole industry because that was a great trade until it wasn't. And I don't remember the details, but I think Three Arrows that played a massive role in them as well. Um, how did that situation come about? Did you do much on that Grayscale? Like, what happened there where they couldn't do redemptions?
Yeah, I mean, I haven't looked at this in detail in a long time, but I was like way in the weeds reading like 1930s legislative regulatory documents and trying to understand it. Basically, the way an ETF work is it has exemptions from all these securities laws to allow it to do real-time creations and redemptions. And it's Rule 144 is one of them. There's some, I can't remember, there's some others. But basically, what Grayscale wanted to do was operate this thing as an ETF without getting approved as an ETF, functionally speaking. And the SEC basically came in and slapped their wrist and said, no, you can't do that. Like, that's not allowed. So really, I mean, what Grayscale wanted to do is they wanted to launch an ETF, and that wasn't happening. So they tried to go around this back end way. They were able to do it. They were able to get this as a listed product, but the SEC basically said you can't do creations and redemptions at the same time. Basically, the whole premise is like that's built for the theory behind it. I don't know how much we want to get in the weeds in it, but it's like if you're doing these closed-end products and it's illiquid assets or like think private equity or private credit or something, they don't want people creating and redeeming exposure, because like theoretically you can create shares and sell it to somebody for 100 and you can redeem it for 50, and there's like this possible issue like with like the investors getting ripped off. That's the whole back end of like those rules. But ETFs get around that. They hold liquid assets. They're constantly traded, so you can keep the underlying asset in line with the price of the actual shares. And the SEC wasn't ready to approve these things for an ETF wrapper yet. So that's really what the back end is. And so the back and forth was that Grayscale trying to launch this as an ETF, not being able to do it. And then money poured in. And as you said, I mean, Grayscale's GBTC was at the center of like a lot of this blow up. Like they 100% were the crux of what happened with 3 Hours. They were involved in what happened to BlockFi, Luna. Like they were like at the center of all this. But a lot of people like to blame like Barry and Grayscale, but I think that's complete like farcical nature. Like people who are making trades in this stuff, this was never going to get unlocked unless it was able to convert into an ETF. And like, if you look at any of our research, we never had really high odds of it getting approved to an ETF. It was just people just like, this has to revert at some point. It's like, there is no mechanism for this to revert. And so people were just acting like it's going to convert at some point, whereas like, that's not how this works. So the people who blew the system up, it wasn't Barry and Grayscale. Like they didn't, you could argue they should have lowered their fees. Maybe I could see that argument. This idea that like, they're the cause behind all this. They're the ones that cause, like, it's just farcical as far as I'm concerned.
Yeah, no, it's. I can remember the exact same thing, like going through the weeds on those documents and trying to figure it out. And it was just a head scratcher. Like, how does this not end in tears? I just don't understand this. But that's one of the exciting things about the market. So anyway, flash forward like 10 years to where we are now. The ETFs in the US, I think, hold something like 1.2 million Bitcoin. So something like 120 billion in total. We've seen, where do you feel that we are now in terms of institutional adoption and from a capital markets perspective? I spoke to Anthony Scaramucci recently. He says we're still very early, but you see that top line number of 120 billion AUM. It's a big number. So where do you think we are in this process of adoption? Are we still early, or is it already mature, or somewhere in between?
Yeah, I mean, I probably think we're somewhere in the middle, maybe leaning towards early, because there are a lot of institutions that are playing in this space now. I mean, obviously, what we're seeing with this explosion of Bitcoin Treasury companies also shows that institutions are starting to play, but maybe not the institutions that everyone thought would be playing. But I mean, it was always something that people thought corporates would put on their balance sheets. But as far as the ETFs go specifically, I mean, the biggest users of ETFs globally, not just the Bitcoin ETFs, are advisors. So when advisors they're the people that control trillions of dollars of wealth, and there are different ways to do this. The early adopters from the advisor side were independent advisors, so they're not connected to a wirehouse or a big bank or a big wealth platform. They can kind of make their own decisions. The rest, a lot of them have really complex compliance situations. Like when an ETF is approved, not every ETF is automatically available on every single platform, whether that's Merrill Lynch or UBS or Morgan Stanley, you name it. You can't just automatically buy an ETF that launches. There's a hierarchy. So usually when something launches immediately, it's a red light, which means no one can buy it under any circumstance via our platform or for our clients, unless it's explicitly approved by our compliance team. Then there's this middle ground where okay, if the client asks for it, you can do it. Or if the client meets a whole bunch of these requirements with their ability and willingness to take risks, then you can add up to X% of this ETF or what have you. So the middle ground is you have to meet some requirements, or they have to ask you, or all these different things. The final is you can literally recommend it to a client for their portfolio. Most of these platforms kind of in the middle, some of them still in the red, where under no circumstance can you buy it for your clients. And more and more of them are getting to green, where if you're an advisor or broker or what have you, you can actually recommend this to your clients if you think it's necessary and there's no restrictions. So we're going towards that. So I know that's not necessarily the institutional side of things you're talking about, but when I think about ETFs, those are the biggest users, and we're still early there. So the biggest holders right now are probably retail of the ETFs. You could guess that. I mean, the GBTC holders, largely retail. And when you see retail, a lot of them are high net worth individuals. People have millions of dollars of exposure to these things. Even clients of Bloomberg who don't do anything with crypto that I've talked to are asking me questions. And I'm hey, you're a muni bond trader. Why are you asking me about what's going on with the ETF conversions and stuff? And they're well, I have a huge position in GBTC. And I just need to know what's going on, whatever. So there's a lot of that out there. But yeah, it's institutions, they're coming. It's a good thing to see. Hedge funds, when we first get our 13F, at the end of 2024, they were the biggest holders of the Bitcoin ETFs. They're very close to being the biggest holders of the Ethereum ETFs. A lot of that was the basis trade. So we have institutions. So hedge funds, they might not be long only into the ETFs, but they're using them for the basis trade. So the way ETFs work is it's almost like a momentum, a snowball rolling downhill. It's like an ecosystem that attracts everyone, right? And the ETFs are at the center. And the more people, even if they're not there for long term, even if it's a bunch of hedge funds or retail investors, everyone's kind of playing in the same pool. And it kind of makes things more efficient. It's cheaper. It trades better. It trades liquid, like water. All those things make it better for an institution. So for an institution to come in, they need to see liquidity. They want to see a lot of assets. If it's an institution that's looking to trade this thing on a medium to long term or even short term basis, they want to make sure it's liquid enough that they can get in and get out without anyone else knowing what they're doing necessarily, aside from maybe a 13F at some point down the line. So as these things have gathered more and more assets, and IBIT and GBTC specifically are extremely liquid, you have a bunch of others that are very liquid as well, you're going to see more and more institutions. So I would say we're more towards the early side, but it's there, it's coming, it's moving along. And this year looks to be pretty damn strong as well. I think the biggest adopters of this, the most assets that are going to come in, might not be from institutions. They kind of tend to do their own thing a little bit necessarily, but an ETF makes it really easy plug and play. But the advisors are what we should be watching to see if they're going to allocate, 1% to 5% of their client accounts to something like Bitcoin or a crypto index fund, which I think could be as big as the Bitcoin ETFs potentially down the line.
So that 120 billion, I guess a lot of it just comes naturally from Bitcoin price appreciation. So maybe the better number is to look at just total number of Bitcoins. How big can that number get? On a mid to short to midterm basis, over the next year or maybe 2 years?
I don't know. If I had a crystal ball, I would tell you. But I mean, it can get as big as money keeps pouring in, right? The thing is that as the price of Bitcoin keeps going up, I mean, everyone knows this, you're going to acquire less Bitcoin for the dollars that you're putting in, right? So a lot of this money, the reason that it has so many Bitcoins is because money poured in early. Like a lot of money poured in when these ETFs launched initially, and Bitcoin was 40-ish K, dropped even lower, and then we just went off the rocket ships. And money pours in every time there's a huge dip in price. Money like kind of trickles out, and then when it starts going back up, like in pullbacks that we've seen, that's when money pours in the most. So I mean, investors are smart. Eventually, we'll get to a point where I think these things will start trading a lot more along the lines of like what's going on in traditional markets. They can be like, they're going to dampen volatility because people are going to rebalance into like rallies and buy into dips more so than, the retail trading frenzy crowd has done. So these ETFs have indisputably changed the way these things trade. I mean, the way that this thing trades around 3 to 4 p.m. now, Bitcoin globally, I mean, it's being moved by the ETFs for sure, as far as pricing goes. So, yeah, I mean, they're huge. I don't know how big they can get, but they're going to get a lot. They show no signs of slowing down is the real answer. I don't know how big they can get. We think there could be a few. We think there's going to be a few more billion coming in. I think the flows this year could be almost as big as they were last year, but we'll see. I know some people think it's going to be bigger already halfway through the year, so we'll see. But I mean, if we get another huge rally and people start piling in, who the hell knows?
How long does you mentioned this process from where it's like a red light and it goes to a green light. We must be well on the way with that process, given like the size of AUM and then the liquidity of it. So where are we in that process, and how long does that typically go before you can get every retail, every mom and pop can have it recommended to them?
Honestly, never. It could never happen for all of them. I mean, really, what ends up happening with ETFs and funds in general on these types of platforms, usually a lot of them, like, we need 3 years of track record, which this is kind of different because it's holding a single asset and you can see more track record. So that's why some people have been able to figure it out. You usually need some level of assets. You need some level of liquidity, like trading volume. And then you can get them approved from that point of view. But it also, like, it usually takes years. So we're a year and a half into these things launching, right? We're not like, actually, we're almost exactly a year and a half in, but like it could take a long time. And a lot of the ones that have already approved these things at some level have moved way faster than they usually do for other ETFs. So things are already moving quicker for this. So the answer is it's really bespoke. It depends on the bank and the wirehouse and the wealth platform you're talking to. Like, they all do things differently, but for the most part, they usually take a long time, like 3 years. So we're maybe halfway into that 3-year process before like a lot of these things will handle it, but they're moving a lot quicker than they normally would. Yeah, so this is something that's misconstrued by a lot of people. A lot of people think like, I have $1 million in the Bitcoin ETF, so I'm just gonna be able to take delivery of Bitcoin to my personal wallet once this happens, and that's not how this works. It's only on the back end with the institutions that can do the in-kind. So the real answer is, I don't think the average person is going to notice anything different whatsoever with in-kind being allowed, at least initially. I mean, basically, some of the top ETFs with the most liquidity, they are trading so tight and so efficiently just because like everyone's figured out how to do this with the cash create model. They figured out how to offset their costs, offset their correlations and things along those lines when making markets, and the spreads are really tight, like way tighter than they are in the spot market, right? So if you're trading an ETF, you can get, the spreads are literally measured in basis points and there's no transaction fees. Where you go find like a regular spot trading platform as a retail investor, you're not going to get that. There's going to be some sort of trading fees, some very high, some are much more comparative, but there's still like tens of basis points usually at the cheapest level. And then you're also going to get hit with a spread that's like orders of magnitude wider than you would with an ETF. So sorry, that was a little bit of a sidetrack. But as far as the in-kind goes, theoretically, if the ETFs were trading wider, like some of the smaller ETFs don't trade as tight, they still trade relatively tight. The in-kind could make it easier to keep markets really tight and concise. So I think maybe some of these other ETFs, not the top 3 or 4 traded ones in the US, maybe they'll get like tighter spreads because the in-kind transaction will like alleviate some of the steps in the process to create a redeem. But at least initially, it's not like most people won't even know a difference. It's more just like the SEC is accepting of how this works. And it's like they're figuring out the best way and the most efficient way to do these products rather than like basically putting up roadblocks to make them less efficient. And then maybe down the line, you could get to a point where somebody could, take delivery. We have some gold ETFs that allow doorstep delivery. Actually, Van Eck has one. So Van Eck, obviously, they have a Bitcoin ETF too. But I mean, that could be years before they figure out how to actually be able to redeem in spot Bitcoin. But I don't think that's out of the question, but that's definitely not happening in the near term. Yeah, it's particularly on like so like for when you're looking at IBIT and GBTC, those things trade so tight and so efficiently. Like I don't FBTC from Fidelity as well, BitB from Bitwise, like and there's a few others. They all trade pretty damn well, so they probably won't be impacted much. But some of these other products that are smaller, I mean, there's 12 spot Bitcoin products right now. So some of those other products might get tighter spreads. But again, if you're an average person, like how much is the average person buying an ETF paying attention to what the spreads are trading at and things like that? They're not going to know.
No, no, especially if you're someone used to trading on a crypto platform.
Yeah. 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 Even the crappy spreads in some of these ETFs and the way they trade here in the US are still orders of magnitude better than probably the spreads you're getting on most crypto platforms.
Yeah. So, okay, I wanted to pick up on one thing you mentioned. You mentioned that the ETFs are kind of influencing Bitcoin's price. You said at specific times in the day, probably specific days of the month. But I think some people are kind of confused and maybe disappointed when they see the massive inflows into the ETFs that it hasn't had a bigger impact on Bitcoin's price. What do you think about those kind of ideas?
Yeah, I mean, I think it's a combination of the flows that we've seen in the Bitcoin and also the money that's being gobbled up by these Bitcoin treasury companies, right? So tons of coins are being bought up there, and people are like, why are we only at like 105, 110, whatever? And I kind of that's my initial inclination as well. Like I'm like, what's going on? And people are like, oh, it's paper Bitcoin. I don't necessarily believe that, but I think it's more so like you have so many people that have serious amounts of assets in Bitcoin, serious amount of capital exposure, and I think they're just unloading. It's OG whales that are selling when we get around this 110 level. There's a lot of people that are just like, I'm just going to sell when we get up here and take some of my profits and move on. And like, so it's basically changing hands as far as I'm concerned. I mean, right now, the way that the supply works for Bitcoin is supply demand. Like, it's not really, the miners unloading what they're doing, their block rewards, what have you. It's more so like people who already own Bitcoin because it's such a small increasing, like even on an annualized or weekly basis, like the amount of Bitcoin that are being newly created, that's not really affecting the supply. The supply is being affected, as far as I can tell, by like people who are OGs already owning Bitcoin deciding to sell some of their Bitcoin. So like that's how new supply is coming onto these exchanges, and prices are set at the margin. Like it's not just because there's way more people that potentially want to buy. It doesn't matter. It's like who's willing to sell at what prices, and that's where the prices are determined. So I mean, we could see a huge leg up at some point, but right now it seems to be like a lot of people are coming and they're selling their Bitcoins, and even all the on-chain analytics show it. Like if you look at it, there's a lot of people that are moving some seriously old coins and selling them.
Yeah, there was one data point yesterday, wasn't there? The guy moved 10,000 Bitcoin. Yeah, I was going to ask about the on-chain analytics. Yeah, yeah, in one transaction. I love it.
Yeah. I can't even imagine doing that. I might have a heart attack before I saw that like that transaction.
Yeah, for sure, for sure. Um, okay, that's interesting. I was going to ask about the on-chain analytics. I haven't looked at the HODL waves in a while, but I guess that's what that's showing as well, right? Is that these older guys that have held it for a while, they're taking profit, and that's just what's kind of capping the price, I guess, at the moment, given all the demand that we see on the ETF and institutional side.
Yeah, I mean, I wish I knew more about on-chain analytics. I trust other people that I know who look a lot at on-chain analytics. And you just look at the charts and you can see, I mean, it's not like blatant day, but like that has to be what's happening. I don't think there's any big, conspiracy here. I mean, you can see the money going into the ETFs. They do have outflow days as well. I think it more impacted the trading. I don't know if it necessarily is moving the price of Bitcoin, but it impacts the way that Bitcoin trades. A lot of the trading happens in that 3 o'clock to 4 o'clock Eastern time, because that's basically when the NAV of the ETFs are settled and when the value of the futures contracts for CME and the CFTC futures are settled as well. They're like, it's broken up. So like basically it's not just struck at the 4 p.m. They use like basically weighted and volume weighted different things over that final hour to give you a dollar amount so that you can't have somebody come in and just, trade 300 million on like at 359.59 and move the price and get like whatever price they want. So it's like there's ways to prevent that sort of manipulation in the way that a lot of these financial products are structured. So you see a lot of trading around them, because if you're making markets in these ETFs, whether you're doing a creation or redemption, you got to make sure you're trading and you're settled up like in whatever you're doing on that side of the trade.
Yeah, it reminds me like years ago, Trace Mayers used to talk about not your keys, not your coins, and they'd have the I forget what he called it, but the thing where everyone would withdraw their Bitcoin at the same time to kind of stress test the whole system. That seems to have moved a little bit out of the Bitcoin and maybe the crypto culture as well. Like we had the proof of reserve thing that came in the wake of FTX and all of that. I wish we could get that going like once a year. Someone could beat the drums and we all pull the Bitcoin off the exchanges and then we just see what happens. That I think that was something really cool and unique about Bitcoin that you could do that.
Yeah, honestly, I mean that's before my time. I've obviously looked at some of Trace's stuff, and I actually met him a few months ago in New York. But he was before my time of getting actually interested in Bitcoin proper and trying to cover it professionally and even personally. Um, I don't know. It'd be interesting to see. I mean, it's not going to move from the ETFs. Yeah.
Yeah, well, that brings me to my next question, right? So if you look at the structure of the ETFs, one thing that's been criticized is that everybody is custodying with the same counterparty, right? So 90%, I think, of the Bitcoin ETF holdings are with Coinbase. Number one, like it seems like there's more choice around custodial counterparties than ever. It seems like every week or month there's new banks and custodians talking about they're expanding into crypto and Bitcoin. So number one, why is everybody custodying with Coinbase? And then number two, is that a systemic risk?
Um, Everyone's cussing with Coinbase because they are the best option, really, is what it comes down to. It's what I gather. They were the first. People trust them. Um, I'm sure there's some cost factors that weigh into it. I think, but I don't think it's the same cost for every ETF out there to use them. But there are people using other products. I mean, Van Eck uses Gemini. There are crypto ETFs in Canada that use Gemini. Fidelity obviously uses their own. BitGo is being used by some as well. And I think that there's actually a new Trump Bitcoin ETF that's coming from TruthFi. I believe they're going to use Anchorage. So like it is being diversified. There are ETFs that now, like a lot of them are adding language that basically says they're going to use multiple custodians. So I think these ETF issuers are aware. They're just safe and they trust like what's going on right now. But I think we'll see like a diversification of, even within ETFs, potentially they might have multiple custodians, which we've already seen. I like that have done this. Some ETFs have done this. I don't know exactly what the split is between them, but I think there's like growing concern with that concentration systemic risk you were talking about. So people are looking to move, wherever their Bitcoin may be, or at least change to use different custodians. And obviously the custodians as well are like, we need to get into this, this ETF custody business. We need to offer a sweetheart deal to somebody. So I think that's also happening on the other end too.
Okay, so it's just kind of a growing pains issue. The industry is a new product, hasn't quite got there, and that was probably the easiest and cheapest solution at the time. I think everybody from a risk management.
Yeah, I was gonna say, I also think like when you were trying to get the ETFs launched, I think for the most part, it was pretty easy just to be like, all these other people are using Coinbase. We're just going to use Coinbase too, kind of thing. Like they're already set up, they're already doing this. The SEC seems like they're going to approve this in this way. So I think that could have also played a factor.
What do you think about combo products like Bitcoin Gold ETFs?
I mean, there's a Bitcoin ETF, Bitcoin Ethereum ETF too. I actually, so like the combo products, and the one was just filed for like, it's like crypto and precious metals. So it's going to be mostly gold and Bitcoin, but they're also going to hold other crypto and other metals like platinum, palladium, stuff like that. I don't know what the weightings are going to be. They're interesting to me. It's hard assets type of thing. It kind of makes sense. But in the ETF world, what we find is for the most part, people want to be able to choose their exposures, right? They don't want like a one size fits all. There are ETFs out there where like they'll give you like the global portfolio of like 70% stocks, and it will be like, X percent in US, X percent international, X percent government debt, X percent like corporate debt. And like you could just buy this and get like a globally diversified portfolio. And those ETFs only have like a few billion in assets. Whereas like if you just take all the different slugs, like US equity, international equity or European equity, and like people like to choose their own allocations, particularly if we go back to those advisors we were talking about. They don't want to hand over a portfolio and it's like, here's 3 ETFs that we're holding for you. And as a client, you're going to be like, you're holding 3 ETFs for me. I can do this myself. So like advisors like to make it more complicated. I think retail investors themselves, many of them like to tinker around the edges. They like to make picks, even if they're going to be long-term buy and hold investors. So I think that will hinder some of the adoption of this, but it's niche enough. The one area that I do think will do really well is crypto index products, which we just got an approval on Grayscale's GDLC. The SEC actually went in and stayed it and basically said you can't launch it yet. So they got approved to launch. Then the SEC commissioners basically said not yet. So I don't know what's going on there yet. There's still a lot of questions there. But I think the crypto basket type products, or even like here's Bitcoin and here's a basket of other cryptos, I think those types of products could do really well because advisors are used to buying, the S&P 500, the NASDAQ 100, the FTSE, they're used to buying basket of products to diversify risk. And I don't think they're just going to be drawn to going for a diversified basket. I think the way a lot of people think about this stuff outside of Bitcoin, most people tend to think, Bitcoin and crypto. I think most people are viewing that crypto side of things largely as the same way they would view betting on .com stocks in the late 90s and early 2000s. A lot of them went belly up. A lot of them were worth zero, but there were a few like Amazon and others that are worth every penny and then some.
Yeah, I wonder if that's kind of like a mistake that you can kind of bring in from legacy finance, where you kind of have that desire to diversify. But if you look at the top 10 names over time, I think there's a famous chart, right, that every year the top 10 crypto names, it's Bitcoin number one, and then it's random number 9 others, and it changes every year.
Stellar Lumens. I mean, they're still around in many cases. Yeah.
Yeah. Well, that's the thing, is that the Dino crypto, it never dies. There's always a bid somewhere. It kind of, I think you can find Dash and Monero and all of it. The Monero guys are probably going to get upset. But there's, all of these older Litecoin still, all of these ones are still out there and trading. They never go to zero. But I don't think the diversification strategy works that well from my perspective. Do you have any thoughts on that?
Yeah, I disagree a little bit. I think if you're going to bet on this other side of the crypto and blockchain infrastructure really becoming the back end system of the TradFi world, essentially, there are likely to be some winners here. And I mean, I don't know the exact numbers, but if you go back to the .com crash, I'm sure the numbers of percentage of companies that were completely failed or eaten up by something else is staggeringly high. But you don't need that many winners to, do well. If you just pick a couple and they, 1,000x or a couple 100x, you're going to be fine. So I think it's just going to be easier to say. And also we find that a lot of with these advisors, it's a lot easier to understand the narrative around Bitcoin specifically, digital gold, digital store of value, peer-to-peer cash, whatever you want to use, right? It's a lot easier to understand than what a lot of these other, including Ethereum and Solana and any other chains you can think of, whatever they're trying to build. It's a lot easier to explain Bitcoin. So my view is I think people are viewing it likely as Bitcoin and everything else. And for the advisors that are going to want exposure to everything else, I mean, I'm sure some of them are Solana is going to be the next change, or Ethereum will is redeeming itself with its L2 strategy and what have you. And some advisors might have views on that, but I think for the most part, there's going to be a lot of people that are just going to buy a basket product. I mean, the products that we're looking at now, like GDLC from Grayscale that was approved. We don't know when it's going to launch. BitW from Bitwise, which holds 10, including Bitcoin, but still it's 90% Bitcoin and Ethereum, right? So it's not like you're taking massive swings and bets on these other assets. It's 70+% Bitcoin and then 10+% Ethereum. And then everything else is these smaller percentage allocations. So for the most part, I think people are still going to lean heavily towards the market cap weighted approach of the crypto space. But I think advisors, I think it could be a huge growing area, the index side of things.
And how do you think that plays out overall? I think Eric's view, I think, was that it'll play out 80-20 or 90-10 for Bitcoin in terms of the ETF space. And it's basically Bitcoin takes maybe 80 or more % of it, and then it's everything else kind of competes for the next 20.
I actually disagree, but I think these index products, so I guess in a way it would be that it would break down that same way if it's just a market cap weighted index where it holds Bitcoin. But I think these index products, if you're just talking about individual assets, so you have Bitcoin, you have Ethereum, you have Solana, you have Litecoin, we can name 50 million XRP. I think it'll be heavily dominated towards the assets will be in Bitcoin, at least as far as the foreseeable future goes. And from talking to clients and investors, that seems to be where people are leaning. Um, and but if you throw in index products, I think they could garner some significant asset. I think index products will be bigger than the second biggest group after Bitcoin. So I think it'll be Bitcoin ETFs in the near future, and then index products once they launch in a couple of years. I think they'll be bigger than all the other individual. Um,
Yeah, I've heard you mention that on other podcasts, and I was thinking. So the question I wanted to ask was: does index products, does that include like the other kind of crypto protocols, or does that include like other thematics like Bitcoin miners or treasury companies or exchanges or whatever other thematics are?
Yeah, I'm just talking about ones that would hold spot assets. Yeah, for the most part. I mean, so we have like those thematic products that hold miners and hold like anybody else that's building and using blockchain. And they've been honestly, they were great in 2017 because the only way to get exposure to the space was those thematic type products like Block, for example, BLOK. Like that's been around for a very long time, and that was the way to get exposure to the space because you couldn't actually buy an ETF, and GBTC was inefficient, trading at 80% premiums, and like you didn't want to buy that for the most part unless you were a retail person and didn't understand what that meant. So yeah, it's all going well, but I'm talking more about like the specific products that we don't have yet. Right now, we have just a Bitcoin and Ethereum ETF together, but we're going to get just wait, like give it a year or two. We're going to have products that hold the top 20, I mean, one was filed for the top 50 coins, I think. I don't know if we're going to get that this year in the first go around, but I mean, the SEC is coming up with a framework, we think, to decide what can go in ETF wrapper and what can't. And issuers are going to wrap and bundle that up in various different ways. And they're basically going to throw spaghetti at the wall in the same way they're going to launch an ETF for pretty much every top digital asset in the top 100. And if they can launch it, they're going to launch it and see if there's enough interest in trading for these things to be successful products for these issuers.
Yeah, I was looking for a document today and I found an old cover for a roadshow that I did in 2018 called the Taiwan Crypto Supply Chain Tour. And we were doing a roadshow of like TSMC and like all of these like different IC and semi companies and saying, this is how you get exposure to crypto. And that was like back in the day. I thought, well, we've come a long way now to doing the treasury companies and that. So that's pretty interesting.
Yeah, I mean, it's a different world now. I mean, for U.S. investors, they were like, I don't know. I think the SEC messed up over the last 6 years, if that's not very clear, because they basically didn't allow people to get exposure in a regulated, safe manner, which a lot of ETF issuers are trying to be able to do. And people got burned by using, exchanges and lending protocols and things like that they just didn't understand, or yeah, BlockFi, Celsius, FTX. I mean, I could keep going for probably 10 minutes, but like, yeah, they screwed up.
As a Canadian, living in Taiwan, like one of the kind of interesting things that I saw is that during that period, it was a lot of the businesses that were regulated in major financial markets. And I think there's a thing in the US where they're a little bit, untrusting about offshore products. But a lot of the big blowups of the last cycle happened in heavily regulated markets, whether it's like the US or peripherally through FTX, which was, arguably kind of US linked. And then in Singapore with Three Arrows. So I think, you were talking about what happened with Grayscale. I feel like regulators have a little bit of a role to play in this.
Yeah. I mean, also, I would argue like if they had approved Grayscale to convert to an ETF, we never might have caught some of this, bad shit that was happening. Like we might not have had that blow up in 2022 because, a lot of that domino that caused most of that was the GBTC discount. That's what caused Three Arrows. They were a huge player in that, and they couldn't actually make right on their bets. And that was the first domino to fall. I mean, BlockFi was impacted. They held a whole ton of GBTC that they couldn't get ARB that premium out. A lot of lending was based on like lending at GBTC as though you could get it at NAV. And maybe it was a good thing that the SEC didn't allow this because it pushed out a lot of the scammers and frauds and people doing a lot of really sketchy stuff in the crypto space. Then again, I kind of come back to like, you also heard a lot of like regular mom and pop retail investors that were stuck in a product, trading at a massive discount, trading with like had very high fees, all these things, because you wouldn't let them convert into an ETF or anyone launch an ETF. I mean, I think the SEC in many cases kind of lost the forest for the trees. They're so focused on this minutia. And it was just like, if you just take a step back, it's better for everyone if you just figure out a way to do this. But here we are. It's all good now. It's going the exact opposite direction. We're going to see some sort of framework in the next few months, maybe even weeks.
So are we going to see like meme coin ETFs? Are we going to see? I've always kind of interested. We get like Bitcoin started as kind of a macro asset, where some of the first institutional guys were gold bugs and those kind of guys that got into it, and now we see people, some of these macro guys talking about meme coins. So are we going to see a meme coin ETF? Are we going to see institutional investors investing into meme coin ETFs?
We won't see institutional investors investing into it. They might be trading it and arbing it, in the same way that we see a lot of people doing, the basis trade and things along those lines. But we are absolutely going to see meme coin ETFs. I mean, the SEC, one of the first things that, the main problem that we had with the SEC, like I was talking about before, was there was no clarity. They weren't allowing people to do anything. They missed the forest for the trees. And the exact opposite has happened essentially since Trump was inaugurated and Gary Gensler stepped down from the SEC. We've seen a lot of, at least not specific clarity, but indication of like where the SEC is thinking. And there's a lot of like public letters specifically from Hester Peirson speeches about like these different things. And one of them is like, meme coins are not securities. Like, they're not in our jurisdiction. That makes them a commodity pretty much, and you can have a commodities ETF. So we're likely to see meme coin ETFs. Are people going to be allocating to them in any major way? I really don't think so. But they will launch, and the SEC, there are a lot of really smart people in that staff, and they're working through ways to handle these things. But you're going to see an ETF for a lot of the top tokens, like top 100 tokens over the next couple of years. People will launch. The way the ETF industry works nowadays is like, we call it a spaghetti cannon. They just shoot like a ton of shit at the wall, and like whatever sticks is what they leave up, and then they'll liquidate and close things that are unprofitable for them. So if they launch there's a Pengu ETF that's been filed, or if they launch like a Bonk ETF or whatever, I don't know exactly where the SEC is going to draw this framework. I do think we're going to see some sort of meme coins. Dogecoin is almost certainly going to get through. So like I keep mentioning this framework, the SEC is going to come up with these rules and regulations about what can go in ETF wrapper, and it's going to be clear and concise. Like, you need to meet these criteria, and it needs to be not this or not that. We don't know. I have a lot of thoughts on what I think is going to go into that criteria, but I think Dogecoin and maybe even this Pengu ETF and some of the other things are going to launch. I don't think you're going to see, some pension buying exposure. That's definitely not what it is. There's plenty of ETFs out there that are like specifically used as trading leverage vehicles, right? They're not long-term buy and hold. They're things you shouldn't be holding for more than a day in many cases. And you can make the argument that some of these meme coin ETFs are potentially going to be the same thing.
Yeah. So you mentioned earlier Kathy Wood, and I think her 2021 she had a $500,000 Bitcoin price target. And I think a lot of what she was looking at is maybe kind of coming to fruition today. So she was basing that, if I remember correctly, about publicly listed companies allocating 5% of their balance sheet into Bitcoin, and that could pump price up to 500,000. Do you think that's what we're seeing now with these treasury companies?
Yeah, I think the treasury company side of things, one, this goes a little bit out of my realm of expertise, right? So I think a few things. One, she gets a lot of shit correct. She gets a lot of slack and hate, but she's gotten a lot of things that like have come true over time. But she's also often very early, like way too early. They're investing in things, and so she gets a lot of slack. But so yeah, that also had to do with like, she was like looking at it like how much value it's moving across chain and all these different things. As far as the Bitcoin treasury companies go, I think you need to break them up into two things, which like it's the people that are like issuing debt and doing financial arbitrage or financial engineering to get exposure to Bitcoin and add it to the balance sheet, whether it's issuing preferred stock or converts or what have you. But there's also tons of announcements of, companies just being like, we want to add, a bunch of percentage points to our balance sheet. We're not doing any financial engineering. We're just diversifying our treasury for whatever reason. So I think that second area is more what she was expecting and predicting, more so than, the ones copying strategy and Michael Saylor. But I think more and more the ones that we're talking about here is like, they're more doing like the same reason that an individual investor would be investing in the space. Like, they're diversifying their holdings, they're investing for the long term, they're, what have you, and their own treasury, their own balance sheet, they're adding Bitcoin to, rather than, the financial engineering side of things.
So, I feel they ask this question all the time, but how do you think people are viewing Bitcoin? Do you think it's as a risk asset, or do you think it is as a hedge against inflation? It feels like kind of maybe in the middle.
Yeah, I mean, it's both is the real answer. I mean, if you listen to BlackRock, I mean, it 100% trades like a risk asset for the most part, not completely like you would expect, but it's definitely correlated to risk assets. There are times where it's extremely correlated to things like the NASDAQ 100 tech stocks here in the US. And there are times where it trades and acts like a risk off asset. I mean, really what it is, I mean, if you listen to BlackRock, when I talk to, I've been on stage with people from BlackRock many times. Robbie Mitchnick is one of the main people who helped launch the IBIT, the Bitcoin ETF for them. They'll argue like back and forth. I mean, even Larry Fink, they don't view it as a risk asset. This is a hedge against currency debasement. It's a way to, like, if your government is overspending or overreaching in different things, it's a way to get out of that system and opt out of whatever system that is. Yeah. So that's their argument. They're like, this is not a risk asset. But you take a step back, you look at the way it's trading, and it's kind of like, no, it trades like a risk asset. It's not trading like gold just yet. Though there are like times and hiccups, and you look at things, you're like, oh shit. Like there was a bit of a disconnection in the way that Bitcoin traded during the whole tariff tantrum with Trump. And that definitely woke up a lot of institutions. Like they were like, Bitcoin's only like at 75 to 80K. Like I would have thought it'd be at 60 by now. And I think a lot of people like saw that and are like, there are institutions that are taking notice of those sorts of things. So I think the middle ground is the right answer. I don't have a strong answer. The way I think about it is a hedge against currency debasement. I don't view it as a risk asset, but there's no denying the fact that right now it tends to trade like a risk asset.
I wanted to ask you about tools on Bitcoin and how are you guys analyzing Bitcoin and crypto and the ETFs, and what kind of tools do you have available on Bloomberg now? I haven't had access to a terminal for years, but I can remember being very excited when Bitcoin and some other crypto, Ethereum and Litecoin were added. But how are people analyzing this stuff on Bloomberg now?
Not well. Is the answer. I mean, so I've been bashing my head. Yeah, I've been bashing my head against Wall since 2017, trying to get them to do more and add more data. We now have we don't really have, there's no on-chain stuff, so you can't look at anything along those lines. You can look at volume and market cap. The pricing system on here is better. Like the Bloomberg, I can look at I can go to something called AllQ. It's like all quotes. And I can look at Bitcoin and I can look at what the high bid, low, the ask, like the current price, the last price on like 15 exchanges, right? So that's awesome to see that. Like it's really good, and I can watch it live tick up and down. And like when there's a lot of volatility, you can see a lot of gaps opening, and it's like I wish I were a trader and I would be trying to take advantage of this. So that's the one area where like Bloomberg is good, but that's more so like it's just the way that the system is already set up on the back end. They can take in pricing stuff. They know how to do live real time pricing and things along those lines. So that's pretty much all that it's really good for. Obviously, anything related to ETFs, Bloomberg has any data point you can think of, real time for the most part. But when it comes to like actually analyzing these blockchains, looking at any sort of blockchain type metric, we don't have anything. And I don't think there's plan to build anything. Bloomberg is still kind of like, they're not fully into this space yet. They're kind of just dipping their toe, and we'll see if that changes, but it hasn't changed thus yet.
And another thing that I think has changed quite a bit is that there seems to be a lot more kind of coverage from analysts. Like I think all of the brokers and investment banks are adding like Bitcoin and crypto analysts now. You must be seeing that as well.
Honestly, Bloomberg went the opposite direction. We stopped a lot of coverage not too long ago in 2022, 2023. We stopped. We don't have a crypto analyst anymore. We told people they couldn't cover it. It's kind of turning around a bit now. It's kind of like when Bloomberg decides that we're going to start doing more things in the crypto space is when like everyone should, sell some of their wallets because like they leaned in a little bit into like it started doing more stuff in 2018, which is when you're probably talking about like right after the futures launch, the peak of that mania at the end of 2017. That was a bad time. And they did the same thing in in mid 2022 before FTX blew up. They were investing in the space, and then they changed their tune again in 2023. So it's a lot of TradFi companies kind of lean in, and then this is a boom bust cycle, and then they lean out when it busts a little bit. When arguably maybe they should be doing the opposite. But it's generally more accepted. Like I remember talking about this in 2018 with people at Bloomberg, and they were like, "You still talking about this? Like this is dead. It was Beanie Babies. Like no one cares about any of this anymore." And now it's kind of just more accepted. Like this is just a part of things now, and you need to understand a little bit. Particularly, like I find that people are in my world, and I sit next to our rate strategist who covers Treasury and the Fed and things like that. They're very interested in what's going on with stable coins, and they're asking tons of questions about on that front. So there's still a lot of interest overall in the space now. But Bloomberg isn't really like investing in any meaningful way into covering the space more so than they already have. We have a lot of reporters. We have a TV show that covers crypto. But I wouldn't say like Bloomberg is like trying to build out its own sort of infrastructure to, track what's going on these different chains.
What about for the rest of the year, for the rest of 2025? What are your key watch points for the next 6 months or so?
Yeah, I mean, the first one is I need to see that framework. So our view is the SEC is going to come out with some framework that's going to basically tell everyone what can go into an ETF wrapper from the digital assets world. It's probably going to include things like, does it have a CFTC listed futures contract? Has a future contract existed for a set amount of time, whether it's 6 months or a year? Does it have a certain amount of open interest and trading volume? Could all play a role. The size of the actual protocol, like what is the market cap? How much of it is owned by insiders? A lot of things that could potentially go into like a clarity bill in Congress could play a role here a bit. What is the float? Like how much is owned by, who owned it initially? What is the trading volume? Does it trade enough on U.S. regulated or accepted exchanges? Is there enough U.S. dollar trading pairs so that we can regulate it and have oversight of it? Like all those things are probably going to play a role. So I'm waiting for that framework to come out because that's when we know the ETFs are going to launch. So we have 12 different assets that have been filed for an ETF now, a bunch of index products. They're all going to launch over the next 6 months. They're likely going to launch by October at the latest. So those are the data points I'm watching. So we're going to get that. We already kind of have a staking ETF with a Solana staking ETF with something that Rex Osprey did here in the US, but we're going to see staking as well in ETFs, including Ethereum. So like all those things, it's going to be a big 5 months, I would say. I think all this is going to happen by November for the most part, at the very latest, probably before that. So those are the things I'm watching. The main thing I'm watching is I want to see some concrete filing with what the framework could look like. It's probably going to be back and forth with the exchanges, the issuers, the SEC, I don't know who else, but some of it should be public and we'll be able to see what they're thinking for what can go into an ETF wrapper.
Got it. And one last question. What do you think is one big misconception that still remains that investors have or journalists have or general coverage has about Bitcoin and the Bitcoin ETFs?
I mean, the one thing is everyone sees the flows and like you were talking about earlier, it's why isn't it moving the price? And it's people don't realize that the Bitcoin ETFs, they're a piece of the pie, and they're a big piece of the pie now. And initially, people were looking at the flows, $1 billion came in. Why isn't the price up? And it's dude, they are there's so much happening in spot and OTC trading desks and on these exchanges. The ETFs are just a piece of that pie. Yes, if there's a huge inflow, they can move the price up, or huge outflow, it can cause the price to go down a bit. But it also depends what's going on with the other 80% of the pie, right? Like I talked about before, people try to think what's going on with the ETFs is what's going on with the whole system. And that is just not how it works. Sometimes it can be the tail wagging the dog, but for the most part, it's mostly the dog that's wagging its tail, right? So that's the biggest misconception I get with people constantly getting asked why isn't more money coming in or anything along those lines. So that's definitely the number one misconception I get. And I don't know. There's a lot of people that have conspiracy theories around this and what's happening, and the ETFs aren't actually holding the Bitcoin, and who knows? I tend to not think that's going to happen. I'm not going to go down that rabbit hole, but I guess if you believe that, just, hold your own coins. I mean, there's nothing saying that you have to use an ETF. It's a free market. You can do what you want. Just hold your own coins, and eventually, if there's anything fishy going on, it's probably going to get broken and figured out.
There we go. Putting out the bat signal to Trace Mayer. We gotta give the system a stress test. All right. Well, James, I really appreciate your time today. This has been a great conversation, and I hope we can have you back into the end of the year to kind of touch back and see how things developed.
Yeah, thanks for having me, Jesse. This was a lot of fun. We hit a lot.
We did. Yeah, it was good. Thank you very much. Appreciate it.